Have you ever wondered how you can make your money work harder for you while potentially growing your wealth over time? Today, we'll delve into the world of trips, exploring what they are, how they work, and why they can be an excellent strategy for certain investors. We'll uncover the pros and cons, giving you all the information you need to make an informed investment decision. So, what exactly are dividend reinvestment plans, or DRIPs? Well, imagine you're a shareholder in a company, and the company is doing well, generating profits. As a reward for being a shareholder, the company decides to distribute a portion of those profits into your hands in the form of a dividend. Now, typically, you would reinvest those dividends as cash. You are free to use that money as you please, but with DRIPs, there's an exciting twist. Instead of pocketing the cash, DRIPs allows you to automatically reinvest those dividends back into the company by purchasing additional shares of its stock. It's like planting a seed with time, and that seed grows into a strong tree. This process of reinvesting dividends can be a remarkable compounding effect on your investment. You see, as you buy more shares, those additional shares will also start generating dividends. And what happens to those new dividends? You guessed it, they get reinvested as well, buying into even more shares. It's a fantastic cycle of growth. The more shares you own, the more dividends you receive, and the more dividends you invest, the more shares you own, and so on. It's like a snowball effect that can really supercharge your investment growth potential. The amazing thing about this process is many companies offer additional perks with their DRIPs. Some provide shares at a discounted price compared to the current market value. Imagine getting a bargain on your investment. It's like buying more for less. What's even better, these automatic purchases of additional shares through DRIP are typically commission-free or come with minimal fees. That means more of your money stays invested with the company working hard to build your wealth. DRIPs truly embody the idea of set it and forget it. By letting your dividends automatically reinvest, you're embracing a hands-off approach to building your financial future. It's a disciplined way to invest. The power of compounding can work wonders over the long run. But as with any investment strategy, DRIPs aren't without their considerations. It's important to evaluate your own financial risks, goals, tolerance, and investment timeline before diving in. Plus, DRIPs may not be ideal if you depend on dividend income to cover your immediate expenses. However, for those looking to grow their wealth steadily over time, DRIPs can be an excellent strategy to consider. The more shares you own, the more wealth you can flourish, and you'll be nourishing a robust financial future like a well-tended garden. So why might DRIPs be a great strategy for some investors? Well, for starters, DRIPs fosters a disciplined approach to investing. By automatically reinvesting dividends, you take the advantage of power of compounding, where you reinvest dividends to generate more dividends, and the cycle continues. This compounding effect can significantly accelerate the growth of your investment and potentially multiply your initial investment many times over. Now that we've explored the exciting world of DRIPs and how they can potentially supercharge your investment growth, let's take a balanced look at the pros and cons of this investment strategy. Pro number 1. Automatic reinvestment eliminates the need for you to actively manage your dividends. With DRIPs, your money goes to work automatically, reinvesting dividends into more shares without you having to lift a finger. This hands-off approach can save you time and effort, making it a convenient option for the long-term investors. Pro number 2, DRIPs can be an effective way to practice dollar cost averaging. Since dividends are reinvested at regular intervals, you end up buying more shares when prices are low and fewer shares when prices are high. This strategy helps smooth out the impact of market volatility, reducing the risk of making ill-timed investments. Number 3, many DRIPs come with little to no fees or commissions. That means more of your hard-earned money stays invested in the company, allowing it to work harder for you and your financial future. Of course, just like any investment strategy, DRIPs also have some potential drawbacks to consider. Number 1, one of the main cons is that DRIPs may result in owning fractional shares. When dividends are reinvested, the resulting amount might not be enough to purchase the whole share, leading to fractional shares in your portfolio. While this might not be a significant issue for some, it's essential to be aware of. On number 2, DRIPs may not be ideal if you rely on dividend income to cover your living expenses. Since dividends are automatically reinvested, you won't receive any cash payouts. If you depend on this income to meet your daily expenses, you might want to consider other investment options that provide regular income. Lastly, remember that DRIPs are not immune to market risks. While they offer a disciplined approach and the potential for compounding growth, the value of your shares can still fluctuate due to market conditions. With any investment, it's critical to keep a long-term perspective and consider the inherent risks involved. However, it's essential to weigh the pros and cons carefully and consider your individual financial goals and circumstances before incorporating DRIPs into your investment strategy. To sum it all up, dividend reinvestment plans can be an excellent strategy for long-term investors seeking a disciplined and hassle-free approach. By harnessing the power of compounding and taking advantage of potential discounts, DRIPs can help your investment grow steadily over time. Just be sure to analyze your individual goals and make sure you do your own research. If you made it this far, thank you so much for staying. And if you found this video informative, please drop a like and subscribe. It really helps out the channel. In the meantime, happy investing.